So we run about 10 billion US globally across 36 portfolios, as the guys have mentioned, most of which are custom institutional mandates. And if you could make me host, Nigel, that would be great. And if you can't, Maddie, if you want to,
Matt needs to because I made him host.
Okay.
yeah, Maddie, if you want to make me host, that would be fantastic.
How do I,
So
Nigel?
You right
Go
click on
to
my face,
participant.
and
Right click on your face
Right click.
and make host.
yeah,
There we are. You're
thank you very much, guys. And so here we go. Yeah. So we run 10 billion US, 16 billion of total AUM. As I mentioned, and Matt cited, we have about 48 professionals in our team, 11 traders, 15 analysts. We've traded about 70 billion US of bonds in the year to date. I've discussed the fact that we run 36 portfolios for some of the largest institutions in the world. And we've customized this strategy specifically as a dVAM solution. All of our products have more or less ranked number one in their universes, in the Morningstar and FE Fund Info universes. And we're really focused on driving as much alpha as possible and excess returns in this space as we conceivably can. We've talked about the large team. In the fixed income market, we talk about debt. You guys are obviously experts in equity and many other asset classes. But just as a little quick primer on what we're trading and what will be in the Smarter Money Credit Fund, we're talking about A-rated on average investment grade bonds. So you'd be familiar with entities like Barclays. Barclays funds itself through issuing shares, which trade on an exchange, but also issuing bonds, which are the debt instruments that we trade in an environment that is not an exchange, in what is known as the unlisted or over-the-counter market. Barclays funding is actually a little bit more complicated than that. And we've shown this on the flow chart on the left-hand side here. So Barclays will fund itself through shares, deposits, what we call cash, and they'll pay interest rates on deposits. They typically pay much higher interest rates on their bonds, and they might be senior ranking bonds or subordinated bonds. And you actually have a little sliver of hybrids that sit between the bonds and the equity. And as you move up that capital structure, the bonds become increasingly safe, almost risk-free. So you would be familiar with the collapse of Credit Suisse in March 2023. We actually introduced a blanket ban on any exposure to Credit Suisse in May 2021. And in various strategies we were running, we're actually short selling their bonds in 2022, and Credit Suisse collapsed in March 23. Their equity was hammered when they collapsed. Their hybrids were wiped out, but their bonds were fully protected. So their subordinated bonds, their senior bonds, and their deposits didn't incur any losses at all. So this is the benefit of investing up the capital structure. And that's reflected on the right-hand side in risk. So what we've just shown here for your benefit is the risk of a few different asset classes. The Smarter Money Credit Fund that we're running is going to have expected volatility of around 3 to 4% per annum. The typical long duration bond benchmark will run slightly higher volatility at 5 to 6% per annum, and your equity portfolios will run volatility normally of around 14 to 15% per annum. So the dVAM Smarter Money Credit Fund is going to give you a risk profile that is roughly 25% or 1/4 the risk of your equity portfolios. How are we going to add value? So Maddie has mentioned, and these are the key points, that we're going to be targeting a yield of 200 over cash or 2% over cash. Cash in the UK right now is 5%. So the current yield, I can tell you today, is just under 7%. In equities, you're getting a yield of 2 to 3%. So this yield on this A-rated bond portfolio, which is well diversified, holding debt securities issued by the safest companies in the world, is paying a very attractive yield. And we're going to target a return after fees that's higher than that. In the last 12 months, our estimated return is actually 10.6% net of fees. So how are we driving that return? And then why would we generate a return that's above the yield? If we're yielding 7%, how are we doing 10.6%? So I'm going to quickly explain that. Normally in bond markets, people drive return through yield. Everyone talks about yield, and yield is just a proxy for risk. And you can generate more yield by taking more illiquidity risk, by investing in bonds that don't trade. We don't do that. We only invest in hyper-liquid bonds. As Matty mentioned, we're trading, half a billion to $1 billion a day. 70 billion in the last 9+ months. And we turn over this portfolio very, very actively. So in March 2020, when markets became very illiquid, we traded $1 billion of bonds in that month alone. And we're very liquid on much lower FUM levels. So we're not interested in taking any illiquidity risk in this portfolio. And it really will be a cash plus strategy. It will be a very liquid, very low volatility, very high yielding ballast and anchor in your portfolios. And the second point is we really don't want to take any credit risk at all. Normally in bond funds, they'll try and drive the yield and drive the return through taking default risk. What does that mean? It means buying Credit Suisse hybrids. Ostensibly, they looked attractive because in 2022, they were paying 10% interest rates. The problem is, of course, Credit Suisse disappeared in March 23 and the hybrids were worth zero. As I mentioned, we put a ban on any exposure to Credit Suisse in May 21, and we were actually shorting their bonds in 2022. So we are hyper conservative on credit risk. We only currently have 200 governments, sub-sovereigns, agencies, or as they're known, or SSAs, and companies that are globally approved for this portfolio. So there are only 200 entities globally that currently qualify for the portfolio, and they're basically going to be government guaranteed companies, implicitly government guaranteed companies, monopolies, oligopolies, but basically firms that are too big to fail. The Verizons, the Metas, the Apples, the Barclays, etc. And then finally, as Matt mentioned, we hedge out not only all interest rate risk, but all FX risk. So whilst you have a global bond portfolio of the safest companies and banks in the world, we won't be taking any currency risk and we won't be taking any interest rate risk. What does that mean? It basically means the yield in our portfolio will move up and down with the cash rate, but the bond prices won't change. So how do we, if we're not taking illiquidity risk or default risk or interest rate risk, how are we driving returns? What we do, and this is where it's slightly more nuanced, slightly more sophisticated, if you'll just bear with me, we're very much like your active equity managers. So we use many different models to price bonds, and we're looking for bonds that are cheap. What is a cheap bond? It's a Barclays bond paying 6.5% that should only pay 6%. Once we control for all the Barclays risk factors, its maturity, is it a 1-year bond or a 3-year bond or a 5-year bond? Its credit rating, is it AA rated, single A rated or triple B rated? Its liquidity, the size of the bond, and where all other bonds are trading. So we actually use up to 80 different models globally. These are bond pricing models that are built in-house at Coolabah. All of our traders and all of our analysts are quants. So most of the 48 professionals we mentioned are quants, and we build all of our own tech in-house. And we're trying to figure out what is the right interest rate for Verizon or Meta or Apple or Barclays to pay us on our bonds. And we want to buy bonds that are paying too much interest for their risk. And as that interest rate normalizes down to our target, we actually get a capital gain. And that capital gain is the alpha, which augments the overall portfolio performance. And there's a direct analog in the equity, I think, lexicon or world. Think about your classic Buffett-style value investor. Buffett's looking for very cheap companies that are very cash generative, very profitable. They're trading on high dividend yields. Cheap stocks, he buys those stocks and they appreciate in price. He gets that capital gain. And as he gets that capital gain, the dividend yield comes down to a more normal level. And we are doing exactly the same thing all day, every day. We need a big team to do this. We have data scientists, credit researchers, macroeconomists, and some of the best traders in the world. We have a very, very comprehensive investment process. But really the opportunity set here that I want to stress is that trading bonds is like trading equities before exchanges existed. And it's actually quite fascinating. In the equity market, it's very efficient. It's very hard to get edge. It's hard to generate alpha. Why? Because if I trade $1 billion of equities in a day, everyone in the world can see the prices. Everyone in the world can see the transactions and the volume that I've traded. And I'm competing against all the algorithms, all the quants, and all that transparent information. The bond market is actually much larger than the equity market. There's much more new issuance every day. IPOs can disappear for months at a time. We're trading new bond issues or new bond IPOs every single day. But the beautiful thing about the market is it's completely dark and opaque. So the 70 billion US we've traded this year, those prices are generally not reported anywhere. They're very hard to access. And it's a voice traded market, which means it's traded over the counter, it's unlisted, it's not traded on an exchange. So that's the first key point. It's very inefficient and opaque and far less efficient than the equity market. The second point is that most of the bond managers are driving returns through yield. They're not doing this active trading. They're not using 80 different models to price bonds to find these mispricings to get the capital gain. That's hard. What's easy is to buy liquid bonds, risky bonds that pay high yield, like those Credit Suisse hybrids. It's easy to buy that stuff, offer a high yield, close your eyes and hope for the best. So the PIMCOs, Januses, and Wellingtons of the world, our peers who we're winning FUM from all the time, those guys are very passive. They're hold to maturity. That's the terminology we use. They're not turning over their portfolios 10, 20, 30 times a year like we are. They're holding the bonds to maturity. And if you hold it to maturity, you just get the yield. You don't get the capital gain. So most of the active managers in bonds, they'll typically hold 2,000 to 3,000 individual securities. Now, if I said to you, I'm an active equity guy and I've got 3,000 stocks, you'd say, what the hell are you doing? You're a closet index hugger. And that's exactly what these guys are doing. And then finally, the smart money used to be the bank traders. But in the 2008 crisis, the banks blew up. They had to be bailed out because of their subprime exposures and other risky exposures. And they were basically regulated out of taking these bond risks on their balance sheet. And so today, the Goldman Sachs and Morgan Stanleys of the world that used to be the smart money in this market don't have the capacity to inventory or warehouse tens of billions of dollars of bonds on their balance sheet. They're not allowed to. Proprietary trading has been banned. And we have stepped into that breach. So our balance sheet can be as large as 16 to 20 billion US. And that would be bigger than any other market maker that we know of globally. We believe that, for example, Goldman Sachs globally only has about $8 billion US of capacity for credit trading, whereas we have something in the order of 15 to 20 billion US. So it's an inefficient market. It's a passive market. It's a voice traded market where there are no algorithms. There's no digital trading. It's like shares in an open outcry environment before exchanges existed in the mid-20th century. And the smart money, which used to be the banks, have disappeared. They've become brokers. I want to quickly show you some data that kind of validates, hopefully, and lends some weight to this hyperbole. Because thus far, it's been a lot of rhetoric. And we want to actually show you the evidence. Now, this is a little complicated, but what you're seeing on this screen is every new bond IPO that we have bought since January 2021. On the vertical axis is on return, on the horizontal axis is time. And we're looking at about 30 billion of new issues that we've traded. So it's exactly the same as an IPO in the equity market, a new company listing on the exchange. But here we're looking at new bond issues. And there are 10 to 20 times the amount of new bond issues globally that we see in terms of or relative to equity IPOs globally. And the only thing you really need to focus on is a few of the key data points we've highlighted. And the first is our median holding period, which is this number here that I'll point to, is just 2 days. So we're buying these bond IPOs and we're flipping them typically within 2 days. The typical credit rating is A. We are making money 92.1% of the time. So if you account for the interest rate the bond pays us, plus our capital gain, or the yield plus the capital gain, we're actually winning sort of 9 to 10 times out of 10, which is great on the $30 billion of trades. The different colors are different currencies we're trading around the world: US bonds, Euro bonds, sterling bonds, New Zealand bonds, and Aussie bonds. We're finding mispricings or cheap bonds 88% of the time. That's what we call the capital gain hit rate. And the typical mispricing is this number, this -9 number. It's a very small number. And basically, it's 9 basis points. It means we're normally finding bonds in the new issue market that pay 6.09%, and then the interest rate drops by 9 basis points to 6.0%. So from 6.09 to 6.0, and that gives us a capital gain of this number here, 0.45%. Now, a lot of my equity friends say to me, Chris, I don't get out of bed for 0.45% capital gains. What are you talking about? Stop wasting my time. The problem, fellas, is we're not earning 0.45% capital gains per annum. We're earning them every 2 days, 0.45% every 2 days. And the IRR, the annual return on our new issue trading is 37% per annum. It's this number here. Now, I can't put all 10 billion US into new issues every day. So I can't deliver 37% per annum, but rest assured, we're trying to put as much money as possible into these new issues, winning 88% of the time purely on capital gains, winning 92% of the time once we account for the interest that we earn for our 2-day holding periods, and competing away these small mispricings, getting that little bit of extra interest that drops down to our target in typically a 2-day period. Now, that's the new issue market. I'm now going to look at the secondary market. You might say, what is that? That's just like you going onto the stock market and buying IBM shares in the secondary market and hoping they appreciate in value, or NVIDIA shares. We're doing the same thing in the bond market. Now, here we don't have the cheap new issue concession or premium, however you characterize it. The new issue market, the probability of us finding cheap bonds is higher. In the secondary market, we're still winning, however, 82.2% of the time. And overall, we're winning about 86% of the time. Here, we're looking at about $20 billion of trades on this screen, again, across different currencies. This is return, this is time. The typical mispricing is about 14 basis points, this number. So that's like the bond yield moving from 6.14% down to 6.0%. But we have to hold for a much longer period of time, about 45 days. So rather than holding for 2 days, we're holding for 45 days in the secondary market. You might ask why. There's no natural catalyst for a change. When you see a fabulous new IPO, or you hear of a new IPO in the equity market, everyone expects it to perform. And it's the same thing in the bond market. A new bond issue, and there are many more new issues, and we're doing them every day than the equity market, but those issues are expected to perform, which is why we only hold them for 2 days. But in the secondary market, the holding periods are longer, and the IRRs are therefore a little bit lower. So they're about 8.2% per annum. And that IRR, that annual return of 8.2% per annum, is made up of about 2.3% interest and about 5.9% capital gain. The capital gain is the alpha. That's the Warren Buffett effect. That's the value we get from getting the cheap bond. It's paying 6.25, that goes down to 6. We get the capital gain, and the yield is the 2.3. So we're doing this in the new issue market. We're doing it in the secondary market. We're winning 80 to 90% of the time. And I can tell you right now, absolutely emphatically, we are the only fixed income manager in the world that has this style. Matt and I just won a 1.1 billion, sorry, I meant to say Fiona and I, my colleague who's on the call with me, just won a 1.1 billion US dollar mandate from one of the biggest asset allocators on the planet. And they said they'd never seen a manager like Coolbar anywhere in the world. And you guys are getting the benefit of that through the dVAM Smarter Money Credit Fund. That is to say, that unique style. And that unique style is why in the last year we've returned 10.6% net we assess in this strategy, whereas the yield's only been 7%. Difference between the 7% yield, which is just the interest rate on the 100 to 200 bonds that we'll have in the portfolio. The interest rate on the bonds will be the yield, the 200 over cash. So that's circa 7% right now. The reason we can do almost 11% net is the alpha drive. And we believe we're getting bigger, better, and better in the sense that we started off focusing on Aussie and New Zealand bonds. Then we expanded into Asian bonds. Then we went into UK and European bonds, then into US bonds. And we've actually had better success in the US and European credit markets or bond markets than we actually have had here in the Antipodes. We have offices in London, Sydney, Melbourne. I know there are New Zealanders on the call. We also have offices in Auckland. We sponsor the Crusaders rugby team and New Zealand's top ski racer for my Kiwi friends. And we're about to open up our Miami office. And I will be moving to the US time zone in just a couple of months. So our trading is really very globally focused. So in summary, we're targeting 200 over cash. Cash is right now 5. Net of fees, that means we're targeting 7. We want to do a lot better than that. Historically, since inception in this strategy, after fees, we've done about 300 over cash. So we're trying to be conservative with the return target. This will be a well-diversified global corporate and bank bond portfolio that's rated A with the safest businesses in the world. We believe we won't have liquidity risk in the portfolio. We believe we won't have default risk in the portfolio. We believe this will be a cash plus anchor in your strategy that's paying a 7% yield, multiples what you get in equities, with very good liquidity and very low volatility, about 25% the volatility of the equity market. And we believe we'll be able to very consistently beat that cash rate as we have done over the last 1 year, 3 year, 5 year, 7 year, 10 years, and since inception, which is what you can really see on this slide. At that point, Nigel and Matt, happy to take questions, but I've got to say, we've never really customized a strategy in precisely this way before. Nigel, if I may correct you, we are actually not offering this strategy to anyone in the world. This is a tailored, bespoke solution that is only available via the dVAM Smarter Money Credit Fund.